Hello, greetings, and welcome to Dividend Blasters. This is our 76th video. Topic today, $1,600. This is what I earned in weekly options premiums income. How did I do it? I sold covered call options. I'm going to talk to you a little bit about covered call options, what I did, and how they work. First, a disclaimer, I'm not your financial advisor. Purpose of this video is for information and education. It reflects my own personal opinions. Please do your own research, consult a financial advisor prior to making any major financial decisions. Covered call options. What is a covered call option? Essentially, it's a financial strategy where an investor who owns shares of stock sells call options on that same stock. This is done to generate additional income through the premiums received from selling the options. And this is key, while still holding the underlying asset. Remember that. You want to collect the premiums and you want to sell, or you want to hold on to the underlying asset. And for that to happen, a particular event needs to occur. I'm going to get into that right now. How do covered calls work? Well, an investor owns shares of stock. They sell call options on those shares. A call options contract requires that you own 100 shares. Covered call. That's what I'm talking about. You own the shares. So you have to have 100 shares to sell one covered call contract. The investor receives a premium for selling the contract. If the stock price remains below the option's strike price at expiration, the investor keeps the premium and the shares. Now, that's really the ideal outcome here. As the seller of the covered call, what you want is you want to agree to a strike price in the contract that is sufficiently, quote, out of the money. Okay, you want it to stay out of reach of market fluctuations and market movements for the duration of the contract so that the option is not assigned, where you are essentially compelled to sell. So that's basically the ideal outcome. However, alternatively, if the stock price rises above the strike price, the investor may have to sell their shares at the strike price. That's what we call assignment. Okay? And that is really where the buyer benefits. They benefit basically by the market price going up because you've already agreed to sell at the strike price. Well, if the market price exceeds that, they're basically buying at a discount against the market price. And then you, as the seller of the option, you are basically missing out any potential future upside. That's why you're getting the premium. So there's some strategy involved here. You need to be careful. You need to be careful on what you're setting your strike price at. You need to look closely at the duration of the contract. And you also need to look at the underlying conditions of the market, the economy, and also the asset that you're selling the covered calls against. All very important. Advantages. What are advantages of selling covered call options? Well, first and foremost, it's that premium you're collecting, income generation. They provide a way to earn additional income from existing stock holdings through options premiums. Risk mitigation. So the premium you receive offers some downside protection against minor price declines in the underlying stock. So if the stock price goes down, you're stuck in a contract. You can't unload it. You're there for the duration of the contract, unless you want to buy the contract back. Flexibility. So investors can repeatedly implement this strategy on the same shares if the options expire worthless. And that's really what I'm after. I'm looking to come up with a decent strategy. And the strategy is selling covered call options, but selling a certain number of options contracts for a certain duration and on certain stocks, if you will. And my goal is to have that happen so that they expire worthless, so that I keep the shares and I keep the premium income. So this is a very conservative way to generate additional income. Really, the person that's taking more risk is the person that doesn't own the shares. They're buying the call option. Now they can make money. Okay, if the trade goes their way, they can actually buy the stock at a discount. So you have to be smart, and you have to consider all factors here. So what are the risks and limitations? Well, there's limited upside. The main risk is opportunity cost, and I talked about this a little bit, just mentioned it. If the stock price rises significantly above the strike price, the investor or the seller of the option misses out on those additional gains. Okay, so you go ahead and sell a covered call option with a strike price of $50, and it goes to $900. you're gonna have to you're gonna have to sell, unless you want to buy the option contract back. But the price of the option will change. It'll fluctuate as the price of the stock changes. So that's why you want to watch what you're choosing to sell covered call options against. And I'm going to talk a little bit about that, because I took some risks to get a higher premium, but I thought it was a calculated risk. Potential assignment is another risk. I talked about the option being assigned. The investor may be obligated to sell their shares at the strike price if the option is exercised. Yep, that's it. The downside risk. While the premium offers some protection, the investor still bears the risk of significant price declines. I just mentioned that. If the price goes down and you're in the contract, you're kind of locked in through the duration unless you buy the option back. Okay, when to use covered calls? Well, you use these when you expect the stock price to remain relatively stable or rise moderately. So you don't want to see uh, significant spikes upwards in the price when you're selling a covered call. You don't want that. Um, you know, if you're not in the covered call and you own the stock, that's great, of course. But yeah, if you've sold the covered call, you don't want that. You want to be in a fairly flat or slightly bullish market. And also, really, when your objective is to generate additional income from a long term stock holding, okay? Something you think you're going to hold on to, and it's a flat market. You don't think there's going to be an assignment of the option, and you've accrued enough holdings, you can sell more contracts and get more premium. But you do need to be careful, because if these are stocks that you never want to part with, then and it's the options assigned, you would need to buy the option back. So anyway, I've said that. Here's just a simple covered call scenario. I'm going to walk through it, and then I'm going to talk about what I did the past week. So let's say you own 100 shares of XYZ stock. It's currently trading at $50 per share. You sell one option call with a strike price of $55. So you think you're sufficiently out of the money. Okay, and that's basically where you think you're kind of safe, $5 above the market price. It's expiring in 6 months. Okay, and the premium of $4 per share. What are the possible outcomes? Well, there's at least two. If the stock price stays below 55, the seller keeps the $400 premium. Okay, they got $400 premium. $4 premium per share, 100 shares, that's your $400. They're going to keep that, and they're going to keep the shares. That's the ideal outcome here. If the stock price rises above 55, the investor may have to sell the shares at 55. Okay, that's where the option's assigned. Okay, the buyer's going to say, hey, the price has gone up. I want to go ahead and I want to buy. I want to buy at the strike price. And they'll get a nice little upside there. But you still keep your $400 premium. So what is the conclusion here before we get to what I did? Covered calls can be an effective strategy for generating income and managing risk in certain market conditions. but you should carefully consider the potential limitations and opportunity cost before doing this. All right, what did I do? All right, so this is what I did. I sold a handful of covered calls here. I don't even remember the number because it started to grow, but I started doing these around Tuesday and Wednesday of the week. So 1, 2, 3, 6, 8, 9, 11, 30. I sold 13 covered calls. I sold one on Amazon, one on Chevron, one on Google, one or three on Nvidia, and I was, kind of laboring over whether I should do that or not because I really don't want to part with Nvidia. It's kind of like the gold standard in my portfolio. Um, Two on SoFi, one on Tesla. That's another one I was kind of laboring with because these two are fairly volatile. They can go up, they can go down. So you're taking a little bit of a risk. Two on UPS and two on Walmart. You can see the number of underlying shares. It's just the number of contracts times 100. I've listed the strike price in the contract. Okay, so you can see Amazon, the strike is 220, Chevron 157.50, Google 177.50, Nvidia 140, SoFi 1550, Tesla 305, UPS 119, and Walmart 99. All the expiration dates today, end of trading today, 228. I have showed the purchase price, and of course, the purchase price is less than the strike price. And then I'm showing the stock price at expiration. Now, so when you look at this, compare the strike price to the stock price at expiration. Amazon expired way below. Uh, Chevron got close. I'm sorry, Chevron breached it. So that's a unique situation where basically the market price breaches the stock price, but it wasn't assigned. Okay. If I'm buying an option and I see it go up a little bit, and maybe this investor, the buyer, has a threshold. They want to see it go up maybe 5% or whatever before they pull the trigger on the option because they think, hey, it might go back down. But anyways, it went up. I still keep the shares because it expired. Google, yeah, way down. It's about $7 under strike. Nvidia, about $15 under strike. SoFi, about $1.50 under strike. Tesla, 292.78, so that's about $12, $13 under strike. UPS got very close. Look at that, 118.66, whereas strike is 119. So it got very close, but it wasn't enough. Okay, couldn't assign the option. And Walmart was close. The strike was 99. Stock price expired at 98.48. So anyway, I basically the ideal outcome happened for me on all 13 of these, which is what I wanted. And I'm showing you what the premium is per share. And so you can see that for Tesla and for Nvidia, the premium is much higher. These are much more volatile stocks, and they're much more subject to, performing very well and going up and breaching that strike price. So you're going to get a higher premium. There's a small fee, and that premium is per share. So you multiply that by every share. So if it's, for Amazon, it's $92 in premiums, less the fee of 66 cents. So that's 91.34, and that's the total fee. So you can see basically, if you go down the list, Chevron got $44.34, Google $50.34. Where I made a fee here, a nice premium, is Nvidia. I basically got $870.99. SoFi, $6.87. It's not much. If I had sold more covered calls on my SoFi holdings, instead of selling, two, sell 10 or 15, that number would have gone up. I don't think it would be anywhere near Nvidia's. Tesla's 509.33. That was another big one. Those are the two big ones, the two drivers of the $1,600 in premiums collected that I get to keep. UPS 39.44 and Walmart 27.34. So to me, I thought that this was a successful um, outing in selling covered call options. It's something that I'm looking to perfect, and the way I perfect it is to sell the covered calls, but make sure I'm going to fine tune my approach, and I'm still working on that on the right assets to sell, the right number of call options, covered call options, and setting the right strike price and balancing that against the right uh, premium that I can collect. I did this for these contracts were all for 1 week durations. Where I can, I'm going to stick to doing 1 week. I think that having that shorter duration allows me to better manage risk. And so that's what I'm after. There are some where you can't do 1 week, some where you maybe have to do a month. One thing I will say is that I haven't done any on ETFs because the return really just doesn't appear to be very robust. It's flatter. So stocks are the ones you want to sell these against. That's been my experience. But you know what? There could be certain ETFs where that may not be the case. I'm still exploring different strategies. So, anyways, folks, that is it. Feel free to look me up on social media. I am on X, I'm on Instagram, I am on Facebook. Dividend Blasters, look for the blue check mark. Also, check out a couple of my colleagues, um, Dividend Snowball on X and on Facebook. And also on Facebook is quality dividend investing and growth, as well as saving and investing for beginners and dividends are us. I did hope you enjoyed the video. I hope you found this to be informative and entertaining. If you did, please give us a thumbs up to like the video, share it with a friend, hit that notification bell so the next video comes out, you will know about it immediately, and subscribe to our channel. We would love to have you. Have a wonderful day. God bless.